Hello, my name is Rans, and today we are going to do a basic financial analysis of a company about which you might or might not have heard. It's a pharmaceutical company and it's quite big in scale as well. But before we start, please remember this is not investment advice. We're just trying to understand about the financials of the company and decide if you want to research further or not. So let's get started. The company that I'm talking about is Dr. Reddy's Laboratories, right? It's a pharma company that deals in generics. So generics are basically the non-branded drugs or the non-branded medicines, but they work in a very similar way, right? OTCs are non-prescription medicines, right? So for example, you can buy them without needing a prescriptions. APIs are used in the manufacturing of medicines and some proprietary products depending on specific medical conditions. So these are the different works that the company is involved in. All right, now let's get started with the financials of the company, right? Looking at first the P&L item, the revenue, EBIT, and PAT. So the thing to understand here is that they performed fairly well till FY16. So revenue was on a good trajectory till FY16, right? But after that, it slipped down and it recovered almost up to the level of FY16 in FY19, and then it has exceeded it, right? So these 3 years were not the best years for the company, so to speak, right? The case with EBIT and PAT is even more complicated, so to speak, because they reached their highest in this year here, highest EBIT of 2,700 crores and highest PAT of around 2,300 crores. So if you look at the growth from FY11 to FY15 in EBIT and PAT here, 65, 12, 25, and here 30, 17, 28, and 19%. So these are good growth rates, so to speak, right? But after that, it started falling and it has kept on falling or increasing, but it has not even reached to the levels of FY15, right? So the max that it reached, the closest, which is not actually close as well, but was in FY19, but after that in FY20 it has fallen again, right? So these years, these 5 years haven't been the best for the company. In 1 year, the performance looks optically good. There has been an increase, but the reason really for that is the fact that the previous year it was a sharp decline as well, right? So challenge with EBIT and PAT that last 5 years haven't been the best, at least in terms. So if you look at it, is the EBIT is more or less at the stage of where it was 11 years back, right? It's 1,300 crores and 1,160 crores. With PAT, it's slightly higher, right? And the PAT here seems greater than EBIT, maybe due to non-operating income in this year, right? So yeah, that is about these moving cash flow, right? So the company has been generating good cash flows. In most of the years, its cash flow from operations is actually greater than the profit, especially in recent years, and it has compounded at a healthy rate as well. So if you look at the compounding cash flow from operations, it's about 16.5%, whereas the revenue is about 9.9%. So I mean, and the profit gets impacted by interest and depreciation as well. But cash flow has been compounding at a good rate, so that's at least a good sign that the company is able to generate sufficient cash. Right. Talking about the cash flow from investing and cash flow from financing, so the company seems to have made regular reinvestments into the business. You can see a lot of these are actually very significant amounts. And not all of this actually relates to the non-current assets. A lot of this relates to the non-current assets, but a lot of investment transactions are also there, like temporarily placing, excess funds in short-term investments and then redeeming them, and kind of funding some bit of investments using, kind of funding some bit of asset investments using the financial investments that the company's made. But there have been considerable and continuous increase in the non-current assets as well. Cash flow from financing. So with cash flow from financing, there are most of the transactions of borrowings, right? Issuing borrowings, repaying borrowings. In fact, in each of the last 10 years, there has either been a sort of small borrowing being raised or a part of the borrowing being repaid. Obviously, there are interest transactions as well, and there is small amount of dividends that are being paid by the company as well. In each of the last 10 years, the dividends have been paid, right? Okay, now moving to the balance sheet item, starting with equity. So if you could see that equity has also grown at a very healthy rate, around a rate of around 16.2%, so to speak, which is quite greater than revenue and slightly similar to the growth in cash flow from operations, right? The current assets have also If you look at the current assets and current liabilities in tandem, their growth has been slightly higher than the growth in revenue, right? Especially when you look at the net working capital, right? Current liabilities probably started with a higher base, so current liabilities and current assets started with sort of a small difference here, and then the differences kind of increased. So if you look at the current assets less current liabilities here, so it started. They started more or less with a lesser difference, but then the difference has magnified as the time has passed, right? So that is why the growth in net working capital seems to be higher than that in revenue, right? Okay, looking at non-current assets have gone through an obvious uptick, right? There have been continuous reinvestments into the business as we talked about, but not all of these non-current assets are actually fixed assets. A lot of investments are might also be there. In fact, both in current assets and in non-current assets, there might be financial investments that the company is holding. So their investments do form a good part of the total assets as well. Okay, now finally looking at non-current liabilities, the company did raise borrowings and the company seems to have basically paid most as well. But still the non-current liabilities seem to be not so significant, at least when compared against revenue. And here you'll see that the non-current liability figure is a negative. That is because I've taken this data from these websites and they've kind of eliminated the deferred tax liabilities and deferred tax assets. That is why the figure is coming out to be like this. So this is one drawback of using data from third-party websites, that sometimes they might regroup data otherwise. But we still get a very good idea, and non-current liabilities haven't been very significant, right? Okay, now quickly let's also once again go over the growth as we talked about revenue, good solid performance here, then not the best performance in these years. EBIT and PAT have actually, if you look here, then the PAT has declined in EBIT has declined in 4 out of the last 5 years, and PAT has declined in 3 out of the last 5 years. That is sort of a challenge. Uh, Cash flow slightly more volatile. That is quite understandable. Consistent growth in equity, that's also understandable. More or less a consistent growth in assets. These are total assets, not just non-current assets, right? Current assets and current liabilities, the growth understandably is quite higher actually compared to the revenue growth because of different changes in current assets and current liabilities. Liabilities have been going up and down, but the thing to understand here is that they don't really form a very significant part. At least the non-current liabilities don't form a very significant part. So solvency is comfortable. Okay. Now looking at the metrics of the company, this also kind of metrics also kind of tell us a similar story about the performance of the company, that it is solid here up to these years, and even if you consider this year as well. So these years of very solid performance in terms of ROCE and ROE. But in the recent 4 years, actually, in all of the recent 4 years, they have been below median. In fact, in the recent 5 years, these have been below median. So median you see 21.7 and 20.2, but in the last 5 years, it has been below that, right? So this seems to be quite a challenge for the company. And part of it can be explained by the margins, EBIT and PAT margins. So as expected, it reached its highest here, when I think the EBIT and PAT are also at their highest, or maybe here. And then, the margins have kind of declined. So if you look at the last 5 years, it has been inconsistent, right? So there has been a fall, then there has been a rise, and there has been a fall again, right? So this is sort of a challenge. Up to this point in these 4 to 5 years, it was still quite stable, at least operating within a 2 to 3 percentage points range. But after that, from this point onwards, it's been quite volatile. And maybe this is due to change in the product mix or change in maybe increase in cost, but this is something that is not a very good sign for a company, right? Capital turnover and asset turnover, if we talk about it, so while on the one hand the margins were not so stable here, and the capital turnover and asset turnover ratios were also not there here, right? So I mean, till this point it was although on a declining trend, but in these years it's been it's what declined a lot more as well, and combined with volatile margins leading to lower returns of capital ratios, right? And similarly, it's the story with asset turnover. It's slightly more stable compared to capital turnover, right? Because it's a larger base as well. But yeah, I mean, broadly it has also been on a declining trend, but in the recent year, it has slightly gone up. But yeah, so in the recent 4 to 5 years, well, basically inconsistent margins and lower capital or lower asset utilization. Solvency positions looks to be quite comfortable. In fact, the asset by equity is at its lowest, right? And the company hasn't found really significant problems in paying back any of its liabilities or any of its borrowings as well, right? CFO to PAT, we've talked about it. The CFO has been greater than PAT in 8 out of the last 10 years. So that seems good sign. The company isn't actually facing any problem in generating cash, and the PAT gets impacted, by interest and depreciation as well. The net cash flow items, if you see here, I mean, if you look at the broad trend, then there has been a uh, net outflow of cash in a lot of years and also on an aggregate basis. But I think that the company is able to, manage its cash flow fairly decently. It's generating good cash flow from operations. It is making reinvestments into the business, and it has, raised borrowings and repay borrowings as well. So I think overall on the cash basis, it seems at least that the company is managing its cash fairly well. Current assets less current liabilities, we've already talked about it, starting more or less with similar lines, but then the difference has expanded and the difference is contracted as well. And the movement here has been slightly more pronounced than the movement in revenue. Non-current liabilities to equities, we've talked about it. This is more or less quite insignificant, so the company doesn't seem to have any sort of solvency issues, so to speak. All right. So now let's come to the highlights finally, and we quickly wrap up. So good revenue growth initially, but inconsistent recently, and poor EBIT and PAT in recent years, right? And the FY20 levels of EBIT and PAT are actually lesser than the FY15 levels. So this seems to be a big challenge. CFO greater than PAT in 8 out of the last 10 years. Cumulative CFO is about 21,300 crores. The cumulative PAT is about 16,300 crores, right? So a good 5,000 crores difference there. Cash flow from investing includes investment transactions, the purchase and sale, and reinvestments into the business, into the fixed assets, as it's quite understandable. Cash flow from financing includes borrowing transactions, which includes redemption, issuance, also interest transactions, and dividends, right? So in each of the years, there has been some transactions related to borrowing, either issue or repayment, and there have been dividend payments as well. Solid increase in equity value, I think this is something that has to be given. The equity is compounded about 16.7% or 16.2% actually, right? So this seems to be a good sign for the company. Company has raised and repaid borrowings, financial leverage at its lowest. So solvency wise, the company seems to be in a good position, right? Growth in non-current assets in line with revenue. Growth in working capital is significantly more than growth in revenue, right? So if you look at the growth in working capital or current assets less current liabilities, although not all the items would be part of working capital, but still at a high level we can understand this. So the CAGR here is about 27.5% and the revenue CAGR is 9.9%. Although it is also because of a very low base here in the a very low difference here in the starting year, and from this year onwards to this year onwards, it's probably more or less, it at least seems to be in line with revenue, right? So because of a lower base, that seems to be the case, right? Return on capital and return on equity greater than 15% in 6 out of the last 10 years, but it has been lesser than 15% in the recent 4 years. So that seems to be a challenge. In the last 4 years, EBIT margins have been below median, they've been below median, and they've also been inconsistent in the last 5 to 6 years, right? Declining capital turnover trend and asset turnover declined in recent years, but has sort of recovered. Although broadly, both the capital turnover and asset turnover, they are on a declining trend, and at least broadly speaking, it's not the asset utilization has not been as good as it was in the past, right? So what's the conclusion? My understanding of the company here is the fact that the company has strong financial position, good solvency, good cash utilization as well, but very inconsistent financial performance, especially in the recent years, whether it is in terms of revenue growth, whether EBIT or PAT margins, or whether asset utilization. So that at least seems to me like the biggest challenge for the company going forward. Let's see how it deals with it. All right. So that is all that I had to share about this company. I did not know much about this company before doing this. Now I have some bit of idea about the financials and the business as well because I went through the website. And if you found this helpful, then please share it. If you have any questions, then you can drop them in the comments. The Excel sheet is available. The link to the Excel sheet is available in the description. And please subscribe for more videos. I'll see you again with another company. Thank you so much for watching.